Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Thursday, November 11th, 2021. And our top story today, we're talking target date funds, new asset classes to be included in this new popular investment. Joining me now to discuss this and a lot more, Randy Plavaika is a journalist with Fund Intelligence. Randy, great to see you again. Thanks so much for joining us on the program this morning.
Great to be here, Jeff. Always a pleasure.
Yeah, and you have recently done a deep dive on target date funds and kind of what they're going to look like potentially in the future, meaning 2022 and beyond, because 2021 is almost over. But I want to work a little bit backwards, and I want to first start with, what are you hearing from what the individuals that we call retirement plan advisors and sponsors of retirement plans? So I would kind of call them allocators. These are people that allocate assets, not manage assets. Sometimes they do. But what are you hearing from this group of population in terms of what the future looks like?
Yeah, I think right now it's been really interesting is seeing a big shift toward not only ESG, but also a bit more private alternative access than before. ESG has been top of mind for a couple of years, and that's kind of a renewed topic that's always going to be, I guess, on the table for us, right? And I think what's really interesting to see now is that a lot of retirement allocators, both from the institutional lens and then also just from the retail lens, are looking for a lot more diversification out of the target date funds that they're investing in, or just the retirement strategies overall they're investing in, whether it's a managed account or something else like a CIT. Really what's been top of mind and kind of a little less surprising than might be expected, but real estate allocation is kind of lacking in the broader target date space. There's a few managers that can do that right now or already offer that, but in terms of like actually having, everybody, on board and making kind of table stakes for having a quote unquote diversified TDF, it's not quite there yet. So real estate's been really top of mind for a lot of allocators. It's something they're trying to tap into. Real estate market's been pretty solid for investments. I've not heard a lot of complaints from my colleagues that cover that sort of beat in terms of kind of the flows they're seeing in terms of the overall success they're seeing. And I guess aside from that, right, there's a little bit more demand for like kind of private equity, private credit access, private credit more so. And I think a lot more managers have been working on that. But private credit, especially getting access into that market and kind of having something else into the TDF, I guess that provides more balance to the overall portfolio as opposed to just kind of a plain vanilla kind of equity and bond mix as before.
Yeah. And so, Randy, you mentioned three broad asset categories: ESG, real estate, and private markets. In your mind, just based on, again, anecdotally, is there a priority here? I mean, ESG, every time I'm talking to someone like yourself or someone in the retirement space, I hear ESG, ESG, ESG. So that leads me to believe that might be one of the top priorities. But again, you're talking to more people than I am. So what do you hear in terms of priorities?
Yeah, what's actually funny is that I think ESG gets more media mentions than any of the above asset allocation or asset classes. But ultimately, I think actually real estate would be more interesting at this point in time. ESG, kind of interestingly, not the amount of demand that they thought was originally going to happen for that at the retail and institutional level. I think at the institutional more so definitely. There's a lot of pension plans, endowments, foundations that want to have kind of a green retirement portfolio. But in terms of like actually putting the money there, the inflows just quite haven't been there yet. There's a couple of bespoke ESG target date series out there that haven't really generated the same inflows as just kind of traditional passive stuff and traditional stuff that isn't ESG tilted. And that's kind of because what people are comfortable with, right? They're kind of used to the stuff that's non-ESG. Not that they don't want the ESG stuff. It's just that the inflows haven't quite really started there. That could change very much. I could be wrong. And all of a sudden in 5 years time, we only have ESG target date funds. But for the time being, I think actually what's more likely, and although it doesn't get that many media mentions or as much media mentions as ESG, would be like the real estate sleeve, right? Having an allocation toward something to that accord, whether it's private, whether it's public real estate, but something, diversifying in that range. Because I think for a lot of asset managers, it's a lot easier to kind of diversify in that range as opposed to trying to incorporate ESG if they've either A, never done it before, or B, their clients really aren't demanding it. I think at this point in time, beyond that, I still think the private markets might have a better chance of making it into the target date picture before ESG fully does. But I still think that we're going to see like a lot of asset managers work on making their processes like ESG friendly, even if they don't have bespoke like ESG lenses to the investing. And that's more of a marketing thing for them than it is like an actual action at times. But I do think that a lot of managers are going to get smarter with how they're investing. They're not going to invest in stuff that's inherently, quote unquote bad. or viewed unfavorably in the markets. And that's just kind of standard practice, right? But I think ultimately in the target date series, what's going to be interesting is basically to see the access to real estate open up.
Yeah, and Randy, I agree with you. I think real estate, private markets, they have a role in these broad, what I would call, target date or account managed types of products by a professional manager. But I want to go back to something, if you wouldn't mind just switching off your journalist hat and putting on your millennial hat, for lack of a better term. I don't even know what that hat looks like. I mean, you have to describe it to me at some point. Is it a hoodie? Is it a knit cap? I don't know. But anyway, my sense in just talking with people, and I agree with you, institutional investors, they want to allocate towards ESG. But my sense is people of your generation, and by the way, on my generation, they want to allocate money to good places. Might we see a increase in flow? Maybe the product or products are just not there yet in terms of how they're created, and maybe it's not as opaque. It's too opaque, not as transparent.
Yeah. By the way, and I live in Brooklyn, so I think the millennial hat would be like a rolled beanie, kind of above the ear situation. So nothing quite covering the ear.
Thank you.
Not great for winter, but absolutely fashionable.
It looks cool.
It absolutely does. I agree with your points. I think right now, like the product and the plan design really isn't quite there to support the retail demand. And speaking anecdotally from like people in my demographic, I think there would be interest in like an ESG portfolio, like investing in ESG all the way from start to finish. The issue more so is that when somebody like myself is first getting into a 401k plan or any type of retirement plan, at this point in time, there's no like ESG from the start option. There's no true like universal ESG thing that we can all get into. A lot of plan providers are saying, here's our pretty much generic portfolio for you. Do you want to be a little bit more aggressive with your equity? Do you want to be a little more defensive? Maybe the markets. But when you're age 25 to 30, it's fine to pretty much be mostly equity tilted, because in theory, right, you want to benefit from markets, and that's kind of just plain thinking for how retirement plan design works. Now, in a couple of years, I would love to see that change. It would be awesome to see kind of more from the start ESG options, so people that were just getting into 401k plans or similar retirement plans could be in from the get-go. But I think right now it's going to kind of come down to record keepers and asset managers working together to make that happen, or the combination thereof. There are a couple asset managers out there that still have record keeping arms. They definitely have the capabilities to do this. It just comes down to, I guess, the demand they're addressing or the demand they're seeing more so.
Yeah, and you have to focus your resources where it makes the most sense. At the end of the day, profitability drives results, and you need that, especially if you're a public company. Randy, I want to take a very quick break. When we come back, we've heard the employer and what I would call the allocator side. Now we're going to talk about how manufacturers are going to respond. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking this morning with Randy Plavica of Fund Intelligence. Randy, thanks so much for staying with us this morning.
Of course, glad to be back.
And you still don't have the beanie on in between the commercial break, but we'll get that for next time. Randy, let's talk about how, what I call product manufacturers, asset managers, mutual fund providers, CITs, how are they responding? What are you hearing from them when you're talking to them? We heard about what allocators want. How are the manufacturers responding?
Yeah, I think in recent quarters and really recent years, I've seen a lot more chatter around CITs, but especially it seems at the end of this year, CITs have come back into kind of a renewed focus. I see a lot more managers looking there now than ever before in terms of like who's actually putting, feet to the floor and taking some action there. And part of it's driven by cost, right? I think offering a target date CIT is a little bit cheaper than offering a target date mutual fund, whether it's active or passive for the most part. Atop that, CITs can have more of a blended approach wherein they're kind of indexing a certain portion of the sleeve and going active on other fronts. So a lot of managers have viewed that pretty favorably. And I've seen a lot more legs there than before in terms of like who's actually doing work there. I won't name any managers specifically, but there's a lot of larger active managers right now that are looking at CITs as basically a method for getting into the same price range as their kind of passive competitors or people that live in the index target date fund world. And obviously what's interesting there, right, is going to drive more competition. All of a sudden, if you're a passive fund user, you might consider the product that's about 10 basis points higher because you're going to get some great active management, from another asset manager. So all that being said, I think CITs have presented a really interesting avenue. And I guess aside from that, there's always been kind of this focus on managed accounts. But something I'll point out is that actually like kind of the inflows, the sales into managed accounts, the data is not all there. But in terms of the actual momentum, I don't think it's actually quite there in the way that like a lot of asset managers would posit that it is. I think for the most part, a lot of investors are still going into kind of plain vanilla target date funds, or if they're going to go into a target date fund that's more bespoke, more custom, they're not going to do it in a managed account format. They might just request a custom target date fund, which I know is a form of kind of a managed portfolio. But all that being said, managed accounts have been kind of weird, right? Because it's a really good way to customize and personalize, but it does often carry kind of a higher price, or it does kind of carry, a more bespoke level of service and the costs that come with that. And not every investor, whether it's at the retail level or maybe even the institutional higher up level, is kind of ready for that, or maybe even needs that at this point in time.
Randy, you mentioned three key asset classes that we thought would be incorporated at some point into a target date fund complex. One you didn't mention, I want to kind of hit on cryptocurrency. We saw earlier, late last month, the creation of an ETF around futures, the crypto futures. So it's not a spot ETF, it's not an actual purchaser of cryptocurrency, but where do we stand with the inclusion? Look, this is, a lot of people say, when I hear about cryptocurrency from advocates, I hear about stablecoin. I hear that this is a great diversifier. A small sliver would work well. So we've talked about private equity, private markets, real estate, great diversifiers in a portfolio. Where do we stand with crypto in a TDF?
I think crypto is a couple of years out, if not more. I don't have a lot of optimism for it right now in terms of being immediately included. And that's not to say that it will never be included. But I think right now, a lot of managers are trying to figure out which investors of theirs actually want crypto at all, whether it's to hold it outside of a fund structure or to hold it inside of a fund structure, whether that's in a retirement account or not. What's kind of interesting is that there's been some recent research done this as well by a couple different industry groups in terms of like kind of what the demands are on the allocation side. And crypto pretty much ranks like lowest on the rung of like what people would want ever in a target date fund. A lot of people even saying like they would not want it to be in it. That's not to say that it won't ever make in it, but I think right now there's a lot of kind of opacity around, how crypto works. And it's not to say that, it's this big mysterious field that can't be understood, right? But it requires education of the advisor or of the plan consultant, also of the investor. And also it requires basically a lot of complex solutions on the asset management and record keeping side to kind of hold it in either a retirement account or just B overall. And so I think right now it's kind of tricky waters to be kind of like, getting into, but it's not to say it won't ever happen. I think what's more likely at this point in time is that managers and record keepers will offer education on kind of, how to maybe manage your own crypto alongside a retirement portfolio. I don't know if the two ever, kind of be married and come together in any sort of way, but in the same way that a lot of record keepers will kind of give you a full picture of all your investments, whether it's, your 401k, maybe you have a separate retirement portfolio outside that, or maybe some other allocations and investments outside that. They might do the same with crypto, right? Where it becomes kind of another thing on your dashboard, on your retirement dashboard that you're monitoring. But I don't know if it ever makes it into the kind of full picture of like, my crypto is in my 401k plan. I'm not even sure what the SEC's thoughts would be on that front, but all that being said, I think it's an interesting way to diversify a portfolio still. I mean, obviously we've seen some pretty good gains in a lot of different coins over the recent years, right? As soon as we think it's done topping out, all of a sudden it goes on like this record run once more. So by all means, I think there is some merit to it in terms of kind of the actual, fiduciary merit, of being a responsible retirement investor. I'm not quite sure the answer to that yet. And I'd rather take a wait and see approach. But again, that's not to say it will never make it in. I just think right now, the desire for it is a little bit more calm than other asset classes out there.
Yeah, and you bring up the ERISA, you bring up the Department of Labor, the SEC, all these groups kind of have to weigh in, and people are afraid of getting sued, and unless they have that safe harbor that protects them, they want to make sure that they're a little bit more on the conservative side. Randy Plavika, great to see you as always. Thanks so much for joining us this morning, and we look forward to having you back again very soon.
Thanks, Jeff.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.